everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 14. This lecture is in continuation with lecture number 11, 12 and 13. Here, we will continue to discuss the provisions of India's 115. In the later lectures, we will also discuss the ICAI question answers, illustrations and examples for sure. So, do watch till end and please comment and let me know whether these lectures are helping you or not. Okay, let's continue with another topic of India's 115, that is principal versus agent. Whenever you are booking or recording revenue for principal and agent, firstly you need to identify whether the person or the entity is principal or agent. What you need to do? For identifying principal, there are three important points. Okay, firstly, principal means that those who satisfy following. Firstly, responsible for execution of the control, the contract, okay, the control. This means that if an agreement has been entered into, okay, a promise has been made, the person who is responsible for fulfilling such promise, for executing such promise, okay, such contract is known as principal. Okay, that is transfer of goods and services, promised goods and services. Secondly, inventory. The inventory risk, or you can say reward, is entirely of that person. If he is bearing the risk and reward, then he will be considered as principal. Thirdly, having right, or you can say discretion, power, okay, to set price of goods and services. The person can decide that at what particular price such particular goods and services should be sold. If he is the price setter, he has all the risk and rewards and he is responsible for execution of such contract, okay, then such person can be known as principal. Okay, now other than that, any person is agent. In simple words, he is the person that is acting on behalf of the principal as and when said, as and directed by the principal. Okay, now for principal purpose, okay, if you have identified that a particular entity is principal, then what you need to do? You need to recognize gross amount as the revenue. Okay, for example, a sale has been conducted of 2 lakh rupees. Okay, then whole 2 lakh rupees sale will be assumed as sale or revenue of that particular principal. But if you talk about agent, the agent revenue will only be restricted to the commission amount and not to the sale amount. Okay, for example, the sale amount is 2 lakh rupees that agent has conducted on the behalf of principal. Fine, totally fine, you get this. And on addition to that, he has received 1000 rupees as commission. So now the revenue that will be recorded in the agent's book will be only rupees 1000. Okay, so here a big point is what? That for principal you need to record gross amount as revenue, whereas for agent you are required to record only commission as the revenue. Okay, next, non-refundable upfront fees, the amounts that will not be refunded back. Okay, if these are related to admin work, then these will be recorded as revenue only and only when the admin work is completed. Okay, administration work is completed. If it is related to purchase obligation, or you can say performance obligation, then it will be recognized and recorded in the books of accounts only after the completion of such performance obligation. Okay, or such performance obligation is satisfied. Determination of transaction price. What is transaction price? It is simply the amount that the seller is expecting to receive in return to the promise that he has satisfied, in return to the goods and services that he has transferred as per the agreement. Okay, so this is the amount that seller is expecting to be entitled for the contract. Okay, this is transaction price. This is simple. Okay, but at times there are variable, or it may be dependent on some conditions. We will discuss each point right now. Okay, so next step comes is determination of transaction price. We will read this once. The amount of consideration to which an entity expects to be entitled in exchange for the transferring of goods and services to customer, excluding the amount collected on behalf of the third party. We have read this definition before as well. Determination of transaction price. Now, while determining, there might be different conditions. Firstly, it might be that there is variable consideration to which it expects to be entitled. Considering the risk. Constraints is in estimation of variable consideration. The variable consideration cannot be predicted an exact amount. There can be an approximation, there can be an estimation, but exact amount cannot be calculated. Okay, so there might be variable consideration. Secondly, there might be that the transaction price is containing significant financing component. That means, for example, you know a term cash price. For example, you are buying a car worth rupees 10 lakh right now. If you do the down payment, or you say if you pay the whole amount right now, it is worth rupees 10 lakh. But if you are paying for the next 5 years in EMIs with interest and all, what happens is the same costing, the same cost of the car becomes for you, okay, is approximately rupees 15 lakh. So the 5 lakh additional is just due to the time difference that you are paying later after 5 years. Okay, such amount is financing component. Such amount is interest component. So whenever the transaction price includes a high or significant amount of financing component, it will be treated as interest. It will be reflected as interest, and it will always reflect the time value of money, that is present value of money. Okay, this is just because of the time value. Next happens is there might be consideration which is not in cash. There might be consideration which is not in cash. Very superb and important point to be kept in mind. Please see it carefully. Always in this condition, what you need to do? Fair value. Consider fair value. Consider fair value. Consider fair value. Consider fair value. Okay. What you need to do? For non-cash consideration, if you received, then such revenue will be recorded at the fair value of such particular non-cash consideration. Okay. For example, you received a particular asset which is, if fair valued, is worth rupees 2 lakh. Then the revenue will be recorded at rupees 2 lakh. Okay. Now fair value, if fair value cannot be reasonably estimated, if not estimated, it is the entity is unable to calculate the fair value of such particular non-cash consideration, then the entity uses the stand-alone selling price of the goods and services. Second step is using the stand-alone price of such goods and services and recording the transaction price, recording the revenue. First preference is what? First preference is the fair value of the non-cash consideration. For example, there is goods and services. Okay, there are goods and services. Okay, such particular good is of worth rupees 1 lakh, for example. Now, if you and you have received consideration in kind. Okay, for example, a laptop. Now, you need to fair value the laptop. For example, the laptop is of rupees 1,20,000. You will be recording the revenue of rupees 1,20,000. In case if you are unable to get the fair value of the laptop, then what you need to do? You need to see the stand-alone price of such particular good. Good was worth rupees 1 lakh, then 1 lakh revenue will be recorded in the books of account. Okay. Non-cash consideration, always go for fair value. If fair value is not given, then go for the stand-alone price of that particular good or service that has been transferred by the seller. Last comes is consideration payable to the customer, reduction of the transaction price or payment. Okay, any consideration that is payable to the customer as a warranty, as part of any return, voucher, etc., then it needs to be reduced from the transaction price. For example, the transaction price is of rupees 30,000. Okay, and there is a payable amount to the customer of rupees 2,000. So the revenue, for revenue recognition purpose, this 2,000 will be deducted from the transaction price, that is 30,000, and the amount of revenue will be recorded is 28,000. Okay. Next, variable consideration. If we talk about, an amount of consideration may vary due to many reasons. It might be due to any discounts, rebates, credits, price concession, incentive, performance bonus, or any other similar methods, vouchers, discounts, etc., due to which an amount can vary. Okay, the consideration might vary. The promised consideration can vary if entity entitlement to the consideration is contingent. Contingent means happening and non-happening, dependent on happening and non-happening of a particular event. If such consideration is contingent to the occurrence or non-occurrence of specified future events, okay, then it is known as contingent consideration. It is variable consideration. Okay. Now an example. Okay, A Limited enter into contract with customer to build a building. to build a building at an agreed consideration of rupees 50 lakh plus performance bonus of 15%. Okay, performance bonus is there. This is 15%. Okay, flat rate. Okay, it's not variable at all. But if the building, there is a condition that if the building will be ready for use in 2 years, there is a condition attached to it on which the such particular performance bonus of 15% is dependent. This is contingent consideration, variable consideration. Okay, such performance bonus depends upon occurrence of future event, that is work completion. Determination of transaction price, very important. Okay, after understanding that whether it is in the nature of whether it should be included or excluded from the transaction price, while determining the transaction price, you have calculated the variable price. Okay, now how to record it, whether it should be included, excluded, when to be recorded. See, how to estimate variable consideration. There are two methods given. There are two important methods given. This is important, even it has ICAI questions. Very simple. Please pay attention over here. When you will do the questions, you will be in a position to solve it on your own itself. Okay. There is first method, that is expected value method, and secondly is most likely method. So the expected value method is used when large number of contracts with similar characteristics. Okay, there are high possibilities, large number of outcomes can be there. Okay, large number of outcomes can be there, then you will be using expected value method, which will include the sum of probability weighted amount. Okay, the amounts will be there and the probability will be multiplied. Okay, for example, there is 10,000, 20,000, 30,000, 40,000. There are 4 possibilities of the consideration. The 10,000 has 50% chances, the 20,000 has 2% chances. Okay, this is how the percentage is there. Such amount, okay, the amount of consideration will be multiplied with the probability, and then what you will get, you will sum it up. The amount that you get is the variable consideration by the method, or by using the method expected value method. It will be used, very important, when there are large number of outcomes and when there is only possible that only 2 outcomes are there, either heads or tails, either yes or no, either you have to pay or not. Okay, if you talk about the previous example, if you are talking about here it is, there is a performance bonus of 15%. There is a performance bonus of 15%. It is dependent on a condition that if it is completed within 2 years, then they will be rewarded. If not, then they will not get this extra consideration. So either yes or no, either they will receive this 15% or not. Okay, there are only 2 outcomes. If this is the case, then for estimating the variable consideration, you will be following most likely method. Okay, most likely method. Are you clear with this point? Are you clear with this point? Please let me know. Okay, this is very important. This is also treated in ICAI question. For at times in question it is given that it is most likely or not, but in present condition, when you are applying to the balance sheet, you have to see that whether the number of outcomes are 2 or more than 2, and then you have to solve the question according to the practical approach. Okay, by using these either of the method. Why we are using the method? Because we do not know exact amount of the transaction price. There is variable consideration. Okay, and what about if we talk about cash, non-cash consideration? Always take fair value, and if fair value is not available, then what you need to do? Take the standalone price of that particular good and service as the transaction price. Next comes refund liabilities. Okay, an entity shall recognize refundable consideration as liability if there is any consideration that you need to pay back to the customer. If there is any consideration that you need to repay to the customer, paid back to the customer in the books of account, or it should be recorded as liability in the books of accounts, and the sales will be done exclusive. This refundable consideration shall not be recorded as revenue. Okay, it should not be adjusted in the revenue. Instead, it should be recorded as liability separately. Okay, now what happens is, if limiting factors in variable consideration estimation, wait, I want to tell you one point if it is here or not. Okay, since we were talking about this refund liability, let's see this chart first and then we'll head towards the previous point. Okay, if we talk about sales return, the refund is always treated as refund liability. Okay, now recognize sale exclusive of the return without return. Consideration for expected return is refund liability. Okay, and when you are reassessing it every year, every end of the reporting period, what you need to do, either the refund liability will increase or decrease, either there will be return or there will be no return, either there will be sales return, the inventory will come in back, otherwise they will not come in. There are only two cases. So either the refund liability will increase or it will decrease. Okay, so further it is adjusted. If there is increase in the sales return, then revenue is debited, revenue is reversed, okay, and the refund liability is increased. If we talk about the sales return have been decreased, if yes, then refund liability is decreased and revenue is increased. Okay, refund liability is decreased and the revenue portion is increased. Okay, now if return is not to be paid in cash, it is not to be adjusted, okay, from the payable amount, instead it is exchanged for one good to another. Okay, there has been any mistake or misplacement, or okay, entity has a practice that it replaces the amount particular good for the customer. Okay, so there is an exchange of goods from in place of one another, then it will not be recorded, it will not affect as the revenue, it will not be treated as sales return. Okay, now read this again. Fifth point, an entity shall recognize refundable consideration as liability in the books of accounts. It will not record it in the revenue section. Okay, now limiting factor in variable consideration estimation. Why there is variable consideration? Okay, there might be that whenever you are estimating or trying to take an estimation of the variable consideration, that what will it be received. Okay, if this is the condition and you are estimating, trying to estimate, get an approximation, if this is the case, then there might be some constraints due to which you are unable to calculate a very approximate and exact figure of the variable consideration. There might be case like this. Then what happens is, in following situation, revenue recognized under variable consideration is subject to reversal. There are higher chances that such variable consideration that you have recorded will be reversed because it is highly uncertain. It is, you are not able to record it very appropriately. The approximation is quite uncertain. If yes, then there are high chances of reversing it. When firstly, the amount of consideration is highly susceptible to factor outside entity influence. The factors that will affect the consideration are not under the control of the entity premises. Okay. Secondly, the uncertainty about amount and timing. You do not know the amount and timing. Okay, when it will be received, this year, next year, or 10 years later. Entity experience for similar type of item is very low. They do not have such experience, they do not have similar experience, therefore they are not able to, they are not in a position to forecast it better and appropriately, exactly. Entity practice for estimation of range, it basically estimates for a range, it does not aim or it does not intend to get a particular figure. Okay, broad range of possible consideration amount is possible, there are higher chances, multiple. Okay, to understand this better, see, if there are only two chances, for example heads or tails, you apply most likely method and it is quite possible to predict the right one. Okay, because there are only two choices. But if there are a wide range of outcomes, there is a higher possibility that you will mistake. Okay, the variable consideration will differ, and at times if it differs, there are higher chances of reversal of the same. Okay, next, reassessment of variable consideration. Every time you need to reassess and reflect the same into the refund liabilities. Okay, reassess variable consideration at the end of each year. Change, if any, will be considered immediately in what? In refund liability. Okay, in refund liability. See, 8th point we have read this. Let's move ahead. Warranties. Very important. Generally, whatever electronic item do you purchase, okay, for example, you have purchased headphones, you have purchased some electronic any other, okay, straightening machine, it always comes with some guarantee and warranty, replacement any, okay. There are at times warranties attached to the products. Nowadays it is very common. So if such warranties can be purchased separately, it's optional. If customer wants to purchase, it has to pay some additional amount. Otherwise it is optional. You can also opt not to purchase or opt for such warranty. If it is separately available, if it is a choice that do you want it to access or do you not, okay, if it has an option to purchase separately, then this is distinct service. This will be known as distinct service, as the entity promises to provide services in addition to the products described functionally. This warranty will be treated as separate performance obligation. This warranty will be treated as separate performance obligation. But if we talk about that customer does not have any option, it is as per the law that the seller has to provide such particular warranty, okay. It is as per the law. The customer does not have any option, okay, does not have option to purchase it separately to avoid it. If this is the case, then this is sure case of assurance. This is sure case of assurance as per the law, as per law, and therefore this will be treated under Ind AS 37, okay. So there might be warranty of service type, of warranty of assurance type. There might be warranties of service type and assurance type. Service type and assurance type. Service type is always treated as separate performance obligation, whereas if we talk about assurance, assurance is treated under Ind AS 37 separately, okay. Next, when the warranty is required by law, not a performance obligation, because such requirements typically exist to protect the customers from the risk of purchasing defective products, okay. These are as per the law and these just serve as assurance and protection. The length of the warranty coverage period. The longer the coverage period, the more likely it is that the promised warranty is a performance obligation, okay. For example, you are a manufacturer of a switch, okay, switchboards and all, plugs and all, okay. Now you know that, okay, that for first 2 months nothing will happen to this switchboard. There will be no malfunctioning, there will be no defaults in this, okay. You are very much pretty sure about this. So if you provide 2-month warranty in this case, okay, because you are sure about 2 months. So since you are very much sure about 2 months, and 2 months is such a shorter time, so there are very less chances that you or your entity will have to provide something, will have to satisfy any sort of promised thing, will have to satisfy any sort of payment against warranty, okay. There are very less chances that customer will come and complain within these 2 months, because these 2 months according to you are highly safe for the product, okay, will not cause any damage to the product. So but on the other hand, there is a 10-year warranty. 10-year is a large term, okay, and now the longer the term, there are higher chances that customer will come and claim the warranty. The entity might have to perform the promised warranties, okay. Now what is written, see again, the higher the chances, the longer the warranty period is, there are higher chances that the entity will have to perform the obligation, okay. See with this, the longer the coverage period, the more likely it is that the promised warranty is a performance obligation. The shorter the period, the lesser chances of converting such obligation, the warranty into performance obligation, okay. Next, the nature of the task that the entity promises to perform. If it is necessary for an entity to perform specified tasks to provide the assurance, then those tasks likely do not give rise to a performance obligation, okay. If there is specified task already laid down, then this does not amount to performance obligation. Now, if entity has both service type and assurance type, both type of contract in one contract, okay, the warranty is there and it is partially service and partially assurance and it cannot be separated, then what you need to do? If an entity promises both an assurance type warranty and a service type warranty but cannot reasonably account for them separately, the entity shall account for both warranties together. If it cannot be separated, record it together. Firstly, try to separate it out. If it cannot be separated, then record it together as single performance obligation. Significant financial component, I've told you before also, when you are paying for example 10 lakh rupees and if you have taken loan and due to EMIs and the interest portion, you will have to pay 15 lakh rupees for the same car. This extra additional 5 lakh rupees is your financial component, that is interest. It should be recorded as interest. Okay. Account interest separately for consideration received in advance and outstanding consideration by the customer. If you have received something extra or you are paying it later or you are there is an additional time value of money included in it. It is like if you are paying right now, you have to pay 100 rupees. Oh customer, if you are paying after 2 months, then you have to pay, instead of 100 you have to pay 105 rupees. Okay, so this 5 rupees is the time value of money, you have added interest amount. So such 5 rupees that is extra will be recorded as interest separately. Interest is recorded only when there is time value of money is material. Okay, rate of interest shall be entity's cost of capital. The cost of capital will be treated as rate of interest for the particular purpose. Now never ever consider interest in 3 cases. When consideration is received but delivery is at the customer's choice. You have received the consideration. You are an entity and you have received the consideration, and you have to transfer a particular good or service, but such particular good is ready. Okay, and you are ready to transfer, but it will be transferred on the request of the customer, on the direction of the customer. You are waiting for the direction of the customer. If it is at the customer's choice, then you do not need to add interest on it. Secondly, when consideration is variable, if there is variable consideration, on what portion will you charge interest? You do not know. Okay, since it is not yet clear that what exact amount will be received. Thirdly and lastly, when difference between promised consideration and cash selling price is due to the factor other than interest. If it is due to other than interest, then please don't charge as interest, and such interest is known as financing component. It is at times hidden in the transaction price. So you know that transaction price can be directly said, or it can be variable, it can be non-cash, it can be dependent on conditions. Okay, it can have financial component. Okay, this was all about transaction price. Okay, next we'll read in the last lecture. Okay, and after that we'll cover the ICA question and answers. Okay, see you in the courses. Till then, take care, be safe, stay tuned. Don't forget to check out the description box.